Today we're looking at Tesla, ticker TSLR. The question is simple. Is this still one of the best long-term growth stories in the market, or is the stock price already charging investors for a future that still needs proof? My short version is this. Huge story, thin margin of safety. By the end, you'll know my fair value range, the price where I would get more interested, and the three numbers that decide this Tesla thesis. 94.8 billion of revenue, 6.2 billion of free cash flow, and $1.08 of diluted EPS. This is not financial advice. I'm using the numbers for education and research. If you're building a watch list instead of chasing headlines, subscribe to FinanceToGo for plain English stock analysis, fair value ranges, buy zones, bull cases, bear cases, and value trap checks. Tesla is hard to analyze because bulls and bears are often arguing about different companies. Bears look at auto margins, EV competition, and current earnings. Bulls look at FSD, robotaxi, energy storage, AI, and robotics. Both sides have a point. Tesla is not only a car company, but the stock cannot ignore the car business either. The auto business funds the bigger ambitions, and the bigger ambitions have to eventually show up in real commercial economics. That is why this is a price and proof stock. The story is huge. The proof still has to catch up with the valuation. The latest filing snapshot shows Tesla with $94.8 billion of revenue, $3.8 billion of net income, 1.08 of diluted EPS, and about $6.2 billion of estimated free cash flow. That is real scale. Tesla is profitable. The balance sheet has a large cash cushion, and the company still produces cash. So this is not a no revenue hype stock. But here's the catch. Those numbers do not automatically support the current stock price. The valuation needs investors to believe that autonomy, software, energy, and future platform economics will become much larger than today's earnings base. That can happen, but it is not free. The proof has to arrive. My FinanceToGo score is 6.7 out of 10. Tesla scores well on balance sheet, strength, growth story, brand relevance, and optionality. It scores much worse on valuation because the market is already paying for a lot of future success. The key issue is not whether Tesla is interesting. It clearly is. The issue is whether the current price gives enough margin of safety for execution risk, margin risk, and the possibility that robotaxi economics take longer than bulls expect. The price chart shows why Tesla is always emotional for investors. This is a stock where sentiment can move fast because people are not only pricing current earnings, they are pricing a future version of the company. That makes discipline important. A great story can still become a painful stock if expectations get too far ahead of the numbers. My fair value range is roughly $180 to $260. My buy zone is lower, below about $160 to $180. At the current price of around $426, I see more valuation risk than margin of safety. I'm not trying to get the exact number down to the penny. I'm trying to separate today's fundamentals from future optionality. In the bear case, if auto margins stay pressured and the market lowers the optionality multiple, the value could be closer to $100 to $160. In the base case, Tesla deserves a platform premium but still lands around $180 to $260. In the bull case, real robotaxi or FSD economics could justify $300 plus. The bull case is that bears are valuing Tesla too much like a normal automaker. Tesla has scale, brand awareness, manufacturing experience, a large software ambition, and an energy storage business that could become much more important. If FSD and robotaxi economics become real, Tesla could deserve a valuation that looks unreasonable, though through a traditional lens. That is what bears may be missing. One real autonomy breakthrough could change the earnings power of the company. The bear case is that bulls are paying for the future before the future is proven. EV competition is real, especially from BYD and other global players. Auto pricing can pressure margins, regulation can slow autonomy, and management distraction can matter when the valuation already assumes excellent execution. What bulls may be underestimating is that the stock can fall even if Tesla remains a strong company. If auto margins stay weak while robotaxi economics remain unclear, the market may not keep paying such a large premium. My FinanceToGo verdict is quality story, too expensive. Tesla belongs on the research list because the optionality is real enough to track, but I would not call it a clean buy at the current price. The thesis improves if automotive margins recover, energy storage keeps scaling, free cash flow strengthens, and Tesla shows real commercial progress in FSD or robotaxi. The thesis weakens if margins stay pressured, free cash flow fades, or autonomy milestones slip without clear economics. The reusable investing lesson is simple. A future story can be huge and still need proof before the valuation makes sense. If you want more strict breakdowns like this, subscribe to FinanceToGo. And comment below, is Tesla still worth paying a premium for a robotaxi and AI optionality, or would you wait for more proof and a better price? Again, this is educational content only, not financial advice.